Jared Dillian. Own your money. Own your life.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. Let's talk about commodities for a little bit. Why have commodities in your portfolio? And the answer is because of what's happening right now. That's why you have commodities in your portfolio. Because stocks are ass, bonds are ass, financial assets are terrible, and commodities are up 11% this year. That's why you have commodities in your portfolio. And I'm not saying that commodities are always the solution or you should invest all your money in commodities because that would be a mistake. But they have to be part of any asset allocation decision. And, you know, the vast majority of people, 99% of people, have a portfolio that consists entirely of stocks or stocks and bonds and nothing else, no commodities. Maybe some gold. There are some people that have gold. But one of the things we're learning now is that gold isn't enough because gold is down this year. It's down like 7% this year. And the other commodities are up. So gold isn't really the solution right now. So it's if there's any time to be long commodities, this is it. And the reason is that the market is pricing in inflation. And commodities are the ultimate inflation trade. Now, inflation is theoretically good for stocks. It's very bad for bonds. And we're seeing the bond market get killed. This is absolutely an inflation trade. Okay. Now, what are commodities? They're stuff that we use. Corn, wheat, soybeans, oil, natural gas, copper, lead, tin, coffee, cocoa, cotton, sugar, all things that we use. Now, you say, why would you invest in something that we consume? Well, the prices vary according to supply or demand. You know, commodities don't produce any cash flow. Businesses produce cash flow. Businesses puke out cash. They pay interest on debt and dividends on stock, but commodities don't produce any cash flow. And not only do they not produce any cash flow, you have to pay money to store them. So that it's like a negative interest rate. It's expensive to hold. Sometimes they go up, sometimes they go down. So why do you have commodities? You have commodities because they are uncorrelated to other things in your portfolio. And this is exactly the time that you should be having commodities. So the question is, how do you invest in commodities? It's easier today than it used to be in the past. If you go back to the 1990s, if you wanted to invest in commodities, you had to buy futures. And even then, you couldn't buy like a basket of futures. You couldn't get exposure to a commodity index that didn't exist. You had to buy individual futures. Then you're dealing with margin, and it's very risky and all that stuff. So it wasn't until ETFs were invented and some of the commodity ETFs appeared on the scene in the 2000s that you could actually get exposure to commodities through an ETF. So there's ETFs and ETNs. One of the ones I look at sometimes is called DJP. It tracks the Dow Jones AIG Commodity Index, and that's an ETN. It's an exchange-traded note, which means that it's actually debt, and the principal of the debt is indexed to a commodity index. It's not stocks. It's a bond that's linked to a commodity index. So there are some ETNs, but it's a lot better than it used to be. I mean, you can buy one of these things, and that's how you invest in commodities. So, you know, we've talked about the 35-65 portfolio. The 35-65 portfolio is a good portfolio, but it doesn't have commodities. Now, you can get exposure through gold. Most of the time, gold is good enough to get exposure to commodities or a basket of commodities. There are ETFs that invest in a basket of commodities. The problem with commodities is the cost of carry. There's a cost to store gold. There's a cost to store oil in one of those tank farms. There's a cost to store corn in a grain elevator. There's carry on futures. These things have negative yield rather than positive yield. And this is the reason you don't make it your own don't make it your whole portfolio. Now, I said you can do gold instead of a basket of commodities. Gold pretty much captures the reason you want to own commodities, because you get exposure to a weaker dollar. You get exposure to inflation. You get exposure to deficits. You have a hard asset that is a store of value. You can print dollars, and we have printed trillions of dollars in the last year, but you cannot print gold. You can't print gold, you can't print oil, and you can't print corn. You can mine for gold. You can create more gold by mining it. You can drill for oil, and you can grow corn, but you can't print it. Also, supply and demand. You know, I have some friends who trade agricultural futures, and these guys are experts at figuring out supply and demand for things like soybeans. You would not believe the science that goes into trading soybeans, including the weather, and not just weather in the United States, but in South America and other places in the world. It's very complex, but you can study supply and demand for gold, supply and demand for oil, for corn, all that stuff. People spend a lot more time than you trying to analyze supply and demand for commodities. Now, if you get it right, if you're speculating and you get it right, you will be lucky. Keep in mind, this isn't commodities for the long run. Commodities don't go up over time. Actually, commodities go down over time. They go down over time. And the reason is because it's human progress. You know, people get better at producing commodities. For example, yields on crops get better. People get more efficient at mining or drilling for oil. People get commodities more cheaply. It's only when human progress goes in reverse that stuff gets more expensive. Commodities went up in the mid-2000s and then went back down again. It's not a long-term investment strategy. You do it to improve your portfolio characteristics. And there is a disaster scenario where stocks and bonds go down, but commodities skyrocket, and that is what is happening now. Also, real estate. Real estate is also sensitive to inflation. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.